Okay, now we're going to look at a sales receipt. And on the sales receipt, we're going to have inventory and kind of look at the debits and credits behind the scenes of this. There's another video on how to look at the debits and credits of an invoice, but we want to understand the difference between the two types of transactions. So on a sales receipt, when I add an inventory part in here, okay, so I'm going to go ahead and add in 10 and I hit save. All right. Now I have it set up that undeposited funds is where I'm depositing to, but I could have deposited to a petty cash account as an example, or a cash and drawer account if we were collecting cash from this customer, but I'm going to leave it to undeposited funds for now. All right, and say maybe I received a check. So then I can go up to my reports and my transaction journal here, or of course we have now reports and the transaction journal is going to be there. And oh, I haven't saved it yet because I changed the check. I'm like, So then we go to transaction journal. You have to save the transaction in order for a transaction journal to be there. So what's happening behind the scenes? So we are debiting undeposited funds, right? Meaning undeposited funds is going up. Okay. When you deal with an invoice, the debit, the first line debit is accounts receivable. So that's what makes a sales receipt different, is you can debit a cash account or an undeposited funds type of account instead of debiting accounts receivable. Then below that, we have our revenue is affected, right? It's credited, which means our revenue went up. Okay, so a credit to revenue means that it went up. It's a positive amount on our profit and loss. We are crediting inventory, which means it's going down. Okay, so when we credit the inventory asset account, it's going down. And then we're also debiting cost of goods sold, which again, a debit to cost of goods sold means it's going up. It's a positive amount. So what does this mean? On the balance sheet, our undeposited funds is going up by $215. And how do we relieve that undeposited funds? Right? How does the credit, we talk about on a balance sheet, we always should have an offset, hopefully, to get rid of that amount off the balance sheet. So we debited it for $215. We're going to credit it when we move the deposit from undeposited funds into the cash account, right? So it'll be a credit to undeposited funds and a debit to cash when we make our actual deposit. On the revenue, or I'm sorry, on the inventory asset side, we have a credit in here, so it's subtracting from inventory asset. So when did it debit the inventory asset? It debited the inventory asset when we received the inventory in, right? So when I first did my item receipt to receive in these gold colonials, then it would debit my inventory asset account, and now I'm selling it, so it's relieving or crediting my asset account. Okay. Now those are the balance sheet type of accounts here. The profit and loss type of accounts that are affected are revenue, of course, and revenue makes it a positive sales type of transaction. So if I look at my P&L for this transaction, it's going to show $215 in a positive amount. And then down here, it's going to show a cost of goods sold of $100. So the net effect of this transaction on my profit and loss, right? I have $215 in sales, $100 in cost of goods sold. So I have $115 in profit or net income. And so we can look at that when I look at my sales number here. So I'm going to call it deposit 2. And then we're going to go into our profit and loss and filter it for number deposit 2. Okay, so nothing yet because I haven't saved it. Let's save it. And now when I look at my profit and loss and switch it to all time, okay, because I was looking at a different date range, I see for this transaction I have $215 in revenue, $100 in costs, so therefore $115 in net income. Okay, so that's the effect of selling an inventory part on a sales receipt.